Yes, welcome back, students. This is our first lecture for chapter number 10. Chapter number 10 is about planning for capital investment or capital investment decisions. This is chapter number 10. We already finished chapter number 9, which was for responsibility accounting. Now, what is capital investment, right? Or what is planning? We know what is planning, right? Planning is to plan ahead for the future or where we want to be in a future. This is what we call it planning. We may heard more detail of it in other management courses. And capital investment is investment. Why we call it capital investment? Normally this is it is part of investment. Sometimes we invest in bonds, sometimes we invest in stocks, right? But investment in bond and stocks can be short term. We purchase some shares today and we can sell it after 2, 3, 4 days. But capital investment normally is the investment which is in fixed asset. Normally we call them fixed assets, right? And where you normally recover your investment in futures. Maybe sometimes it takes you 5 years, 10 years to return your investment, right? So that's why we call them investment in a capital asset is a capital investment decisions. So capital investment decisions are very important, right? Because you make your decision based on existing information and see what you will get it in future. So very important concept in capital budgeting is the time value of money, right? Which we have already seen in other courses, like in financial management course you must have studied it, or some other courses. Time value of money. The basic concept of time value of money is that the money we receive today is not as same as in the future, or in simple word, dollar received today is less, right? Present value for dollar received in a future is less than a dollar received today, right? So this is a basic concept of time value of money, right? Now in capital investment decisions, long-term operation assets, remember those which we purchase, long-term operation assets, they are the capital investments, right? When we purchase or let's say we construct a new building, or when we construct a new plant for production of cars, right? So once those operation assets are purchased, right, and those investment which is in these assets, it can be extended for some future period of time. So what we invest something today, right, and we get a benefit something in the future, right? So this is a basic concept. We invest let's say 10 million in constructing a new chemical plant of a petrochemical firm, but how we will recover it? We may recover this money in the future, right? We will use that plant asset for next 5, 10, 20 or 30 years, right? So that's why understanding time value of money concept is very important, so that it will help us to make rational capital investment decisions. Time value of money, the concept, it says that the value of a dollar which we received in the future is less than today's dollar's value. Or if we have further into a future, right, if you have further into future, the receipts is expected to occur, the smaller is the present value. When a company invests in capital asset, it basically sacrifice your present dollars in exchange for some opportunity to receive a future dollars. I'll explain these in some examples as well here. This is a concept, we call it economic equivalence, right? In order to make decisions, we want to compare a cash flow, right, between now and in the future, right? So economic equivalence exists between cash flows that have same economic effect and they could be traded for one another. Means that what is the value of P dollar today and what we will have it after future, well, what will be the F? So P today or F in some n years is same, right? So this is what we call it economic equivalence. And with this one you can compare different alternatives, different projects to select which one is most reasonable and most acceptable, right? The different projects have different amount and timings of cash flows, right? But using an same appropriate interest rates make them equal in economic sense. Yes, coming back to where we stopped, right? Economic equivalence is we call it that when we calculate a P or F of any project and then we can compare them and see which one is better to make a decision. It will be more clear in later slides and when we solve some more questions. Now this is what we call it our basic formula for time value of money, that what will be a future value, right, F, right, of a P amount, right? That if you deposit P dollars today or if you invest P dollars today for some period of time N, for 2 years, 3 years, N is a period of time, right, what will be that amount in the future, right? Or this is a formula, F equal to P times 1 plus I over N. With this formula we can calculate an F when P is given, right? What is the P today? So what will be the F? So with this formula we can use F, future value of some present amount. This is a one way. Similarly we can use the same formula to calculate a P as well, right? This is to calculate for F when we have a single amount of cash flow or single amount of money, right? Or we call it a single cash flow series. We can use F equal to P times 1 plus I power N, or P equal to, we can calculate the same way to calculate P. Yes, this one, right? This is what we call it a discounting concept, right? When F is given and you have to calculate a P, this is the formula, right? Why we call it a discounting? Because if F is given, right, let's say F is 1000 and I is 10%, so what is the P? It will be less than 1000 because value of dollar today is less than what we receive in the future. This is a basic concept of present time value of money. So we can use these two formulas to calculate P or F. Now what is I, or interest rate or rate of return, or sometimes we call it the minimum rate of return, right? What is a minimum rate of return for each company? Is it a 3%, 5%, 7%? Normally it represents as a percentage, right? And normally this is, we call it cost of capital, right? What is the cost of capital, right? What is capital? How we get a capital is we may get a capital by issuing shares. When you issue shares, then the shareholders expect us to give dividend, right, or to increase the value of shares, right? This is what they expect. Or we can get a capital in any company by issuing bonds. That is another way, right? For bondholders, they expect timely interest payments. So these all combines cost. We call it cost of capital or minimum rate of return, right? So mixture of this creditors and owner cost is considered as cost of capital for an organization. How we calculate it? Again, it's not part of this course, right? Normally it is part of finance courses. How do we calculate cost of capital. But for mostly time value of money, like in this cases, interest rate or rate of return of any investment will be given to us, and we can use that one to calculate present or future value. So this is a formula for present value, what each term represents. F is the amount at the end of a period. F. P is the principal amount or present amount. I is the interest rate, right, as a percentage, or it should be as a percentage, right, annual interest rate. Capital N is time, normally in years. This is to calculate F, or similarly we can use it to calculate P, which is the same thing, F equal to P or P equal to 1 plus I raised to power minus N. So you can use this formula or this formula to calculate F or P, whatever is unknown. Next concept is how we convert these future cash inflows into their equivalent present values. Now here you can see that easy rental, this is an example in our book as well, easy rentals, right. This is given on page number 449 in our book. Easy Rentals wants to add LCD projectors to its product line, right. They want to add to their product line some this LCD projectors, right. If Easy invest 178,571 on January 1 and requires a rate of return of 12%, the company will expect to add the 200,000 cash inflow at the end of first year. So basically what it says here, that if we have, I'll show you here, right, that if P is 178,571, rate is 12%, what will be this amount after 1 year? As of present, today it is 172,000. So how much it will be, right? So this one is not given, F. So using this formula we can calculate future value will be 200,000. So after 1 year, this amount at this interest rate will become 200,000. So this is how we calculate, right? Or if you have the same thing, you can calculate, let's say we have same number, for example, F is given, and you have to calculate a P, right, using this formula. This is F, this is rate I, and this is N is 1. So present value of 200,000, which you get it after 1 year, as of today it is 178,571. This is what we says here in this question, right, that you can use this formula. This is the same thing what we have discussed, right, calculating a P with F as given. So it's the same thing, just calculated in a different way. I recommend you to use the formula F P equal to or F times 1 plus I power minus N. Now sometimes present value table will be given as well instead of formulas, right. We have this table given in our book as well on appendix 1 at the end of a chapter. These tables are given. Present value factor table. What is the present value factor tables? For example, if you look at here for what is same how it was calculated, 200,000 times 0.892857. What is this number mean? Right. What is the formula? F, which is 200,000 multiplied by 1 plus I raised to power minus 1. So what is 1 plus I? 1 plus I is 0.12 raised to power minus 1. Basically you will get this number 0.892857. This number multiplied by 200,000. This is the same thing, F. So 1 plus I raised to power minus N. This is given here in our tables in our books as well. There are some tables given on page number 466. These tables are there. you can use a table to find out this one, or you can simply use the formula directly. So what I recommend you to is to use the formulas directly, then it's easy to calculate F or P. Or you can use a table. This is F multiplied by, this is the discount factor we call it, right? From table 1, you can, if you look at table at 12%, and look at here 1, you can see it is 0.892857. If you look at the table on page 466, this one, you get it on this table. Now, sometimes we may have an annuity. What is annuity? You already know in finance, right, that it's an equal periodic payments, rent of your apartment or home, or insurance on your automobile. Every month we pay some fixed amount, right? This is an example of an annuity. Now let's look at this example. Assume that Easy Rental is going to receive 200,000 at the end of each of the next 4 years. So at the end of each of next year, this company is going to receive 200,000 in year 1, same amount, year 2, same amount, year 3, same amount, year 4, same amount. So basically for 4 years, if you simply add it, it becomes 800,000. But since they occur at a different period of time, right, so they are not same, right? So company uses 12% interest. How we determine the present value? So how we calculate a present value of this, I will just show you here in this slide, right? Let's say you want to calculate, now this is our scenario, right? We are going to receive, this is year 1, let's say year 1, year 2, year 3, year 4. These are the years, right? So every year we are going to receive 200,000, right? So this is what we are going to receive. This is what, right? Now just focus on here, right? So year 1, we know that by mathematics it is, we just add them, it is 800,000. But as for the time value money concept concern, it says this and this are not equal. This 200 and this 200 is not equal. This 200 and this 200, or this with this one, they are not equal. Why? Because they occur in a different period of time. So in order to make them equal, or this is what I discussed earlier, the concept of economic equivalence, you have to bring them at some common point of time, right? Either you calculate their P, right? Let's say if I look at here in 0, means what is their P today? You can calculate a P, right? Or after 4 years, at the end of 4 years, what will be F, right? So this is what we call it, present value and future value. What will be P or what will be F, right? So how to calculate it? This is a formula for an annuity. If you want to calculate a future value of annuity, this is the formula: F equal to A 1 plus I to the power n minus 1 over I, right? This is easy way to calculate a future value of an annuity. Let's say if you want to know how much this will have after 4 years, so using this formula you can find out, it will become this one. This will be the answer, 955,000. So you get that after 4 years it will be this much amount, right? It will be more than 800,000. Why? It is because of the compounding concept, right? So future value is using this formula for 4 years. Similarly, present value, what, let's say how much they have, their value is as of today, right? Present value, this 800,000 today, if you discount it, and as of today it is 607,470. So now economic equivalence says that whether you receive, let me show you. insert. Where is the yes. So basically what it says here, that whether we receive, see, F means 955,000 received after 4 years, or 607,470 received today, they are same. This is what we call it economic equivalence. Whether you receive 607,470 as of today, this will be the present value of this, or future value of this is this. So this one and this one are same thing, right? So this is a very basic concept in time value of money, right? That in future more, present is less than the future. That's why when we purchase a car on installment, when we pay cash, which is present, we pay less, or if we pay on installment, we pay more, in the future amount will be higher. So this is a basic concept. How it is calculated? So this is a formula to calculate future value of an annuity or present value of an annuity. This is the formula you can calculate. In your book on table number 2, this not A, but this value is given as a factor. We call it present value of an annuity factor at $1. It is given, right? So you can check anyone, for example, and you can find out what is those numbers, right? What is given is those factors which you can calculate or use these formulas to solve these questions, which is easy, not difficult, right? So now in this question, the 200,000, so what will be their present value? So this is what I have shown you. Present value is 607,470. This is how it will be calculated using these two formulas, right? So now you can also solve it just to check your answers as well. Just check it. It should be 607,470. Okay. Now there's another concept, we call it ordinary annuity assumptions. The question which we just solved, this one here, this 200,000, what it means here, that we receive 200,000 at the end of year 1. This is, we call it ordinary annuity assumption. This is the assumption in our formulas, in a important concept in time value of money, that we receive this 200,000 at end of year 1, 200,000 at end of year 2, at the end of year 3. This is, we call it an ordinary annuity, unless it is a beginning annuity. That is a different concept. We are not considering it at this point in time. You may see that one in some other courses of finance. So capital investment decisions often involve uncertainties about future cash inflows and outflows. These assumptions inherent in the ordinary annuities. So simplify the calculation process. So here this is what we mean: the end of year 1, end of year 2, end of year 3, end of year 4, not in the beginning, right? So this is a concept of ordinary annuity assumptions. Yes, so we'll continue on the next slide about present value of an investment opportunity. What is a present value? This is our next concept again. And just to remind you that we have already discussed these things before also in finance. It's the same concept of present value, right? Or what we call it net present value to evaluate a project, right? So net present value is basically, if we go to next slide, right? Well, net present value is subtracting the cost of investment from present value of future cash inflows, right, to determine the net present value of the investment opportunity. A positive net present value indicates that investment will return or will give a rate of return higher than that of required return, and a negative net present value means that the return is less than the required return, right? So NPV is basically how we subtract a cost from present value of all future benefits. Let's look at one example which is also in your book as well to explain the same concept. Very simple example. It is on page number 453 and 454. This example is there on page 953. Let's assume that Easy Rentals can purchase the LCD projector for this amount, 582,742. The company has a desired rate of return of 12%. The investment will provide a 200,000 cash inflows for the next 4 years. Should Easy buy the projectors? Now, how to calculate a net present value? This is the same example which we discussed before as well. This is the example that, see, this was the given information. These are the 1, 2, 3, 4 our cash inflows, right, for next 4 years. Now, if you purchase this equipment, if they this at 582,742, what is the cost of this projector? Basically, cost is normally in terms of negative because it is 582,742, right? So this is the cost, right? Cost of the machine. Now, how to compare between any project, right, and its cost? Now, the cost of this machine is this much in terms of negative, and what is the present value, or P, right, or present value of our future cash inflows, right, of inflows. Now, this number is already we have calculated, right, this present value. This is the present value, right, which is this one, right. So, present value of inflows is, we calculated this one using this formula, right? So this is a present value, this is the cost. So now what it tells us basically that in point 0, see, at point 0, as of today, this is the cost because we spent this much money. As a result of how much we are going to receive, right? So present value of our inflows is right. So this is the present value of inflows against the cost. Now both as of today. Again, as of today means in time period 0, this is the cost. Time period 0, this is the present value of all these benefits. So now net present value says NPV is, basically if you add these two, what is net means how much we have after deducting our cost basically from our value. So it is so net present value is 24,000 at 728 if the interest rate is 12%. So this is how you calculate. This is what we call it net present value, right? Right. So this is how it was calculated. So 24,728. This one, how it was calculated. This is net present value. So since net present value is positive, so this project should be accepted, right? That the investment earns more than the desired rate of return of 12%. So this company Easy should invest in this LCD projector project. Why? Because NPV or net present value is positive. Once your NPV is positive, you should accept the project. So this is just another example in your book. So try to solve it by yourself. It's easy, simple, and this should be your answer. Just try to practice because here you have NPV negative, which is different. Right. Next concept in capital investment project is evaluating those long-term projects. One technique was net present value. This is just another technique which we call it internal rate of return of an investment opportunity. Now, what is internal rate of return? This is the rate of return at which present value of cash flows equal cash outflows. If I go back to this question, basically at which rate, let's say this is unknown, right? This is what it says, that at which rate this and this will be equal. Present value of cash flows and cost will be equal. At which rate present value of inflows will equal to the cost, right? This is what we call it internal rate of return, right? Right. So this is the same example here. What it says here, at which rate of PV, see here this one is at 12%, which is given. Let's say if it is not given, so what is the value of I which give us the same amount, not exactly, approximately the same amount, right? Let's say if I change this one to 14% as an example, see it's almost same. So if I change this one to 14%, so present value of inflows is equal, same. So what it shows, that IRR, so this becomes our internal rate of return, because at this rate of 14% cost and present value of inflows are equal. Let's say if I put it 12%, you can see here, now it is more, so NPV will be higher. So, but for IRR, the concept at which rate these two are equal. This is what is the internal rate of return, is the rate at which present value of cash inflows equals the cash outflows, right? So this is the same question which you solve. How do we can solve it? Sometimes it's tricky, right? We don't know what is the rate, so you might use this method if you have a table given. Remember, see, now if we have an the cost, and this is the annual benefit. If you divide it, you get this number 2.9137. Since it is an annuity, you go and look at the annuity table in your book. Remember, at the end of a chapter you have a tables for present value, and see where you find this number. So if you find it in this one, it means 14%. It's confirmed now that at 4 times 14, so now it is confirmed, n is 4, so at 14% rate it will be IRR. So IRR will be 14%, as I confirmed it here as well. If you change it to 14%, you can see here at a 14% cost and present value are equal. So how do we calculate? Either you can do it by this way, find it and look at a table, or you can do a trial and error method. 12%, you say, let's say you try it, instead of, let's say we don't know, we put 13%. See, it is 594, so it means we must increase. If you, let's say, increase it to decrease to 10%, so it is more, so, right? So in order to decrease this number, you have to increase the interest rate, let's say 15%. So it is little bit close. So if you 15, and then you can reduce it to 14% and so it is basically, this is method we call it trial and error method. This is a one way, or you can use this method of using a table. First you calculate this number, then look at a table, and from the table you can find out that it is 14%. So this is how basically we calculate internal rate of return. Now, measuring investment cash inflows. Normally in real life, what are the cash inflows? Cash inflows are the benefits which we receive from investing in any project. What are the benefits? It could be increase in a revenue, incremental revenue, right? Increase in revenue, which is every year, which is an annuity, or you may save a cost. How we can save a cost? Let's say we purchase a new machine. As a result of new machines, our labor cost is reduced. So it's a cost saving, it's also a benefit, it's an inflow. Or third one, I'll come to it later, or salvage value, right? What is the salvage value? Basically that this is another source of cash flow. At that end of a project life, what will happen to the machine or equipment we purchase? Can we sell it? If we sell it, you get cash inflows, right? But that salvage value is only at the end of the project, right? In order to calculate a P of salvage value, you use a different formula as compared to P of cost saving, because it is every year. So this is annuity, but this is a one-time payment, right? Single cash flow. This one is annuity, so we have to use different formula to calculate P or F, whatever, depending on the question, right? How to calculate P? These are annuities. This is a one-time payment at the end of the project, as well as working capital, right? Now, what is a working capital, right? It is the amount of working capital at the end of a project. Working capital is released, right? For example, initially, when we start a new project, maybe we need, when we sell it something on account, we have receivables, we have inventory, we have cash. So these are all working capital requirement. Initially in the project, they are outflows, but at the end of a project, the same amount becomes inflows, right? So these are cash inflows. So basically we have four types of cash inflows, right? Cost saving, which is annuity. This one, increase in revenue, is annuity. This is release of working capital at the end of a project life, and this one is salvage value, which is also release at the end of a project life. This is inflows. Similarly, outflows, for any project we need an initial investment, how much it's going to cost. As a result of purchasing a new machine, maybe operating expenses are increased, so operating expenses are annual. This is annuity, and working capital commitments increase here. Increase in working capital commitments, it's also our cash outflow in the beginning, right? It depends where it is occurred, normally in the year 0, right? So for example, investing in a machine may require to purchase some of the supplies, for example. So those supplies will result in increase in the working capital requirements. So I'm not solving here, but you have in your book exhibit 10.5 is an example of how we calculate a net present value. This is another case study or a long example given on 10.5, right? Detail of that information is on page number 456, that you have two alternatives and you have to select one of them. So how we are going to decide? Basically, we are going to calculate a net present value of each alternative and compare whichever is the highest, we select that project. So another method of calculating or evaluating a project is a present value index, right? Or sometimes we call it profitability index. This is another method of evaluating a capital investment project, right? One is present value, one method is internal rate of return. This is the third method, right? I'll repeat. First is net present value, right? Second method is internal rate of return. The next method is profitability index or present value of index. This formula is very easy, right? We call it present value index. In some books they call it profitability index, right? How we calculate present value of cash inflows divided by present value of cash outflows. So if you look at exhibit 10.5, which I mentioned earlier, in that exhibit 10.5 already these numbers are calculated. So this is the present value under alternative 1, this is present value of inflows, this is present value of outflows, present value of inflows, present value of outflows, and now you have two alternatives. So this one, which one to select? So the project which has highest PI or PV index, we must select that project. In this case, alternative 1 should be selected because PV or index of this project is higher. So alternative 1 gives us or yield a higher return than alternative 2. This is using present value index or PV index formula. Now internal rate of return, as we said before, management uses internal rate of return, right? If it is higher return, the more profitable the investment is. Now how can we calculate IRR? I just explained we can use Excel to make the process efficient, right? Or you can use a table, right? So you can use different methods to calculate. It's a complex method to calculate, but Excel provides a functionality, or trial and error method you can use to calculate, as I explained earlier. Now this is just another example on evaluating two projects, right? Project 1 and project number 2, right? You have opportunity to invest in one of these two projects shown below here. Project 1, project 2. Both requires an investment of 6,000, right? And return a total cash inflow of 8,000. So initially you will spend 6,000 is the cost, and how you will get the return? You get this one in year 1 or period 1, 2, 3, 4. So total you receive 8,000. In project 2 it is equal 8,000. Now if you desired a rate of return of 10%, which project you should invest? Now how do we calculate? We can calculate again. See, these are at a different period in time, different amount. We cannot calculate. So what we can do is we can make a simple analysis by calculating their, let's say, net present value. One way to select a project, right, is using net present value. For project 1, what is NPV as of today, and what is the NPV of project 2, and then select which one give us the highest NPV, right? How do we calculate a net present value? Present value of these, present value of these all, one by one. This one, this one, this one, this one, minus cost, right? You will get what is your NPV. Same thing for second project. Calculate present value, minus it from the cash of 6,000, and see which gives us the highest NPV. On next slide here we have calculated it using 3,500, right? How you can calculate it with the factor or using our formula which we used before, right? This see, present value, let's say what is the present value in this one. First one is 3,500 at an interest rate of 10%. See, 3,182. This one, how present value calculated, right? 3,500 multiplied by this, or using this formula to calculate, it's the same thing. For second year 3,000, but n will be 2. Similarly, if I put here 3,000 and n is 2, so then it is 2,479. Similarly for year 3, 1,000, so n is 3, this is 1,000, so if you calculate, it is 751. This one is 500, it will give you 342. So these are the present value of these cash flows. So 3,500 after the one you receive after 1 year, as of today in year 0 it is 3,182. This one which you are going to receive after 2 years, today the value is this much. This one you are going to receive after 3 years, this is the value. 500 after 5 years, but today it is 342. So the present value of all cash flows are calculated, you add them, right? This is the present value of cash inflows. Outflows, we have only one in year 0, so present value of cash outflows is same, so 6,000. So say this minus this, you get 754 is the net present value of project 1. For project 2, because it is equal payment for every year, right, 2000, so using annuity formula, present value of annuity, this one, using present value, this formula, this one is, you can calculate, this is it is 10%, so it is P is 633,973, right. So project 2, it is 6,300, sorry, what is the amount we need to spend? 2,000, sorry, it is not 200,000. If I change the, it is not, right. So 6,340, this is how calculated. P is this is 2,000. So this is how it is, the cash flow was given, right. So it is 6,340. This is how it was calculated, present value, using this formula, 6,340, or using a factor you can calculate it. So 6,340 minus present value outflows is 6,000, same, so 340. So which project should be acceptable or should be preferred? Project 1 is 754, project 2, this is a NPV, net present value. So this project has a highest NPV, so we must prefer this project. Another method is to calculate a payback period method. We call it a payback method, right? What is a payback method? Sometimes we want to know, instead of net present value or rate, sometimes we want to know about a time. How long will it take for a project to recover our initial investment? How long? Will it take 5 years, 2 years, 3 years, 6 years, and then compare with whatever the benchmark of that company. If it is less than that benchmark period, we should reject the project. If it is more than that, if it is less than a certain benchmark, we accept. If it is more, we should reject. Now, very simple way to calculate a payback method, right? Very simple. Payback method, net cost of investment divided by annual net cash inflows. Very simple to calculate payback period. Now, how do we calculate? Very simple. Let's say we have an initial investment of 100,000 and every year we get 40,000. This example, this is just an example that Winston Cleaners can purchase a piece of equipment for 100,000. This is the cost. And now this equipment will reduce a labor cost, which is a benefit, right? Cash inflow by 40,000 per year. So annual benefit is 40,000 over a 4 year. So what is the payback period? So it is how long we will recover our investment? 40 in year 1, 40 in year 2, 80. Then 20,000 is less, so it is kind of half year. So if we have a short payback period, it is better. Less the pay period, it is better, because it takes us a less time to recover our investment. This is another method of evaluating capital investment projects. One was net present value method. Then we looked at internal rate of return method, right? Then we looked at PV index method, and then this is the fourth method, which we call it a payback method. Sometimes instead of here we have an equal cash flow, sometimes we have unequal cash flows. If we have an unequal cash flows, means every year we have different amount, right? Now see here in this example that a company purchased a machine for 6,000 with cash inflows shows below. You invest 6,000 and these are the benefits you will get, right? What will be is payback period? Can we calculate it from here? What will be the payback period? Means how long we will recover 6,000? How long will it take? It will take us 1, 3,000, 4,000, 4 plus 2, 6. So it will take us 3 years to calculate payback period. How we can calculate it? It's very simple. You can just add these amounts, right? Annual amount from 3,000, right? And add a cumulative amount, annual amount. First year is 3,000, Next year 3 plus this 1000 is 4000. Next year is this 2000. This is given from here 6000. So since when we reach 6000, we know that this is our cost, so we stop here. So from here we can see, oh, we recover our investment. So the payback period here is 3 years. Very simple. Another approach is to calculate an cash flow when it is uneven, not same. Then what we do is we just take a total of all our cash flows from the project, divide by the project life, which is 5 years. So 1500. This is our average annual cash flow. Then we can use the same formula which we used before. Cost divided by average cash flows. It is 4 years approximately instead of 3, right? But this is also correct, right? You can see here this is 4 years, but if you look at previous, it is 3 years, right? It will take 3 years if we use a cumulative method, but if you use an average method, it will approximately take 14 years. So both methods are correct to calculate a payback period. Last item is, we call it a post-audit. Now what is a post-audit means? At the end of our decisions, when we make a capital investment decisions, right? So we have to analyze the technique which we used to justify the original investment, right? So whether our NPV method was correct or not, or IRR method was correct or not, did we use a right rate of return, right? So it's a continuous process where we learn that what should be the I we should use, the cost of capital or the rate of return, or which method tells us about right approach. Any approach we can use, but with experience of making different decisions, we make an audit, means we evaluate, we go back, right, and see what was our actual NPV and how we estimated, and see which method gives us the best result. So we audit ourselves and see the thing into detail, and how we can learn this capital expenditure process, how we can improve decision making in capital expenditure process. So I'm going to stop here. This is where we end our lecture for chapter number 10. It's an easy chapter. We finished. So hopefully you will understand and do some practice, solve some questions from exercises as well. And also we have a self-study review problem on page number 467. So I always recommend you to solve this question and see whether you understood or not, or if you have any problem, anything, please feel free to send me an email. Thank you very much and best of luck.